Assalamu alaikum wa rahmatullah. In the name of Allah, the most gracious, the most merciful, praise be to Allah, and peace be upon His Prophet Muhammad, his family, friends, and the followers until the day of judgment. Inshallah, we'll start with this course, inshallah, as I stated with you before. This is accounting for corporations, and as I said before, corporation is an entity separate and distinct from its owner. This corporation, as I said before, is different from sole proprietorship and partnership. This corporation has characteristics. The main characteristics of corporation are: number one, and the most important one, is separate legal existence. Separate legal existence. It means a corporation is separate and distinct from its owners, and it acts in its own name rather than in the name of its stockholders. And this is different from what you studied in the partnership and in the sole proprietorship. The second characteristic of corporation is limited liability of stockholders. And also this one is very important because of its separate legal existence. Creditors of corporation have recourse only to corporate assets. Have recourse only to corporate assets and the assets of the company to satisfy their claims. Thus, the liability of stockholders is limited to their investment in the corporation. It doesn't extend to their own personal things like house, like money, like accounts in banks, etc. So this is also very important one. The third one of the characteristic of the corporation: transferable ownership rights. It means ownerships of a corporation can sell their shares of capital. The shares or the stocks are transferable units. Stockholders may dispose of part of or all of their interest by simply selling their stock. But you notice that the transfer of ownership to another part is entirely at the desire of the stockholders. It is according to his will, to his discretion, not to enforce to transfer his stocks to others. Also, there are some characteristics only, but less important, but also it is distinguish the corporation from another companies. Among these characteristics, beside the three I mentioned, there are corporation management. Corporation management, here it is separate from the owner. So the corporation can hire a professional managers to run the company. And this characteristic, besides the three mentioned before, are considered advantages to a corporation. Also, there are another characteristics for the corporation, like governmental regulation, and this one considered as disadvantage. And also there is another characteristic, it is ability to acquire capital, and this one we consider it advantage, not disadvantage like governmental regulations. So because this one ability to acquire capital, it is very easy in the corporation to increase its capital when it requires to do so, because the present shareholders or stockholders and the potential ones can take part in the increase of capital when it is needed, and this is advantages. And so the corporation has continuous life. It means unlimited life, and it is, if it is limited according to the charter of the company, but we can extend these years, this life of the corporation. So there are another characteristic, and this one consider also disadvantage. This one is additional taxes, because the corporation, when it achieves profit, they pay tax, and the dividends distributed to the stockholders, they will pay tax. So there is additional tax not there in the partnership and in the sole proprietorship. So it consider this one a disadvantage. So again we can mention these characteristics and classify it to advantages and disadvantages. These advantages are: number 1, separate legal existence; number 2, limited liability of stockholders; number 3, transferable ownership rights; number 4, ability to acquire capital; number 5, continuous life; number 6, corporation management professional managers. And this one, the corporation management professional management, this one consider advantage and disadvantage in the same time, because corporation management is an advantage to a corporation because it can hire professional managers to run the company, and it consider disadvantage to a corporation because it prevents owners from having an active role in managing the company. So this one, number 6, corporation management professional managers consider advantage and disadvantage in the same time. Also, we have the disadvantage, the governmental regulation, and these governmental regulations are so many because it is in favor of stockholders to keep the rights of common stockholders. So this one is disadvantage, although it is in the favor of stockholders because it is too difficult to establish a corporation compared with the partnership or sole proprietorship. It doesn't need more complicated government regulations like this. And the 7th characteristic and the last one, which we consider it as disadvantage, is additional tax, and I explained it. Again, additional taxes means the company pays income tax for the profits they achieved, and the dividends distributed to the stockholders, they pay tax for this one. So there are additional taxes in the corporation. After we studied the characteristics of the corporation and classify these characteristics to advantages and disadvantages, we come to forming a corporation. In forming corporation, we should know some terms. The first one is a charter. A charter is a document that creates a corporation. Charter is a document that creates a corporation. Another one, or another term we should know in forming the corporation is bylaw. Bylaws are the internal rules and the procedures for conducting the affairs of the corporation. Again, the bylaws are the internal rules and the procedures for conducting the affairs of a corporation. They also indicate the powers of the stockholders, directors, and officers of the corporation. The other term we should know in forming corporation is organization costs. Organization costs are costs incurred in the formation of a corporation. Organization costs are expenses as incurred. So these are terms we should know when we form a corporation. The last point we should know about corporation is the rights of common stockholders. In the corporation, there are two types of stockholders, but the common stockholders is the principal one, and the common stockholders have rights. These rights are: number 1, vote in the election of board of directors. Vote in the election of board of directors and incorporate actions that require stockholders' approval. Any actions requires stockholders' approval, we should have a vote, and this is one of the rights of the common stockholders. Number 2, the stockholders have share in corporate earnings through the receipt of dividends. When anyone receives dividends, the common stockholders have the right to receive this one. From the right also to keep the same percentage ownership. To keep the same percentage ownership. What does it mean? When new shares of common stock are issued, then they can buy, they can acquire, or they have the right to buy, to acquire, to purchase the same percentage, to keep the percentage ownership rights. Preemptive right. We call it preemptive right. Preemptive right, it means to keep the same percentage ownership. Preemptive right, to keep the same percentage ownership. Also, among the rights of the common stockholders, share in asset upon liquidation. When we liquidate the company, they have their share in asset after the creditors. They can take share in assets upon liquidation. For corporation, we have different financial statements. Some are common, but it is different, like income statement. The financial statements for corporation are income statement, retained earnings statement, and balance sheet. The income statement differs from the ones in the partnership and the sole proprietorship because we have income tax expense. This income statement has income tax expense because this is for the corporation. And we have a retained earnings statement. This retained earnings statement, as I stated before, this one starts in the first year from the transfer all the net income to the retained earnings statement. And then we take any dividends from it, and the remainder of the balance, it would be the right of the stockholders. The right of the stockholders. Anyway, we are going to study retained earnings statement in detail later, inshallah. The third financial statement in the corporation is the balance sheet. The balance sheet also has different from the other ones because it contains in its liability and owners equity, it has a stockholders equity section. Stockholders equity section, and this is the same or similar to the owner's equity in the sole proprietorship and the partnership equity in the partnerships. This is stockholders' equity section, and we are going to study it also very soon. This one consists of two elements. The first element is unpaid capital and retained earnings. After studying the financial statements for corporation, we have to know what is meant by authorized stock and issued stock. Authorized stock and issued stock. The maximum number of shares that a corporation is legally allowed to issue, we call it authorized stock. This is authorized stock, the maximum number of shares that corporate is legally allowed to issue. On the other hand, we have issued stock. The issued stocks is the shares the company needs in the time being. The company needs now. The company needs this part of capital now. So we issued the one of shares, of the number of shares issued now. This we call it issued stock. So again, we have authorized stock and issued stock. Also, we can have another stock. This one we will explain it when we study the treasury stock. We can explain also the par value and the market value. Par value and the market value. The par value of common stock is a legal amount per share. Legal amount per share, which usually indicates the minimum amount at which a share of stock can be issued. Again, par value is a legal amount per share, which usually indicates the minimum amount at which a share of stock. The par value is a legal amount, so any time when we issue stock, we issue it at a par value. Par value, the amount written in the share itself. This is the par value. It's a legal amount per share. So the par value doesn't different from any time. All the life of the company, the par value is the same. It doesn't matter for the time. If you issue shares after 30 years, for example, or more, then it should be issued at par value. But in the same time, we have the market value. The market value of stock, which after the time of issued the shares at the beginning at the beginning years of the corporation, when we need to issue more, we issue these shares at the market value of stock. And this is totally different from the par value, because the market value of stock depends on a number of factors. It depends to determine the price of the market value. It depends on a number of factors. These factors are the company anticipated future earnings. The company anticipated future earnings. Number 2, its expected dividend rate per share. Its expected dividend rate per share. Number 3, its current financial position. Its current financial position, if this financial position is strong or weak, it depends on it. And also, number 4, the current state of the economy. The current state of the economy. And the last one is the current state of the securities market. The current state of the securities markets. So, this market value, I think it is equal to the price of the share we sell it or buy it in the stock market. So one of the factors is the securities market, the state of the securities markets. It affects the market value. So there are 5 factors affect the market value. Again, we should differentiate between par value of common stock and the market value of stock, which is totally different from each other. In issuance of stock, we should notice that we can issue stock cash, and we can issue stock for services or for non-cash assets. Again, stock is issued for cash, services, or non-cash assets. Non-cash assets like building, land, machines, whatever. And services, when the company needs services, we can issue stock for it. So, the cost should be measured at either the fair value of the consideration given up and or the fair value of the consideration received. Again, the cost should be measured at either the fair value of consideration given up or the fair value of the consideration received. So, if we have land, then we issue shares equal to its market value, and so on. If we have services rendered to us, we can issue shares equal to it at market value. Then we come to treasury stock. Treasury stock, it means the corporation may acquire its stocks or shares. The corporation may acquire its shares, and in this case we call it, when the corporation acquire treasury its stock or its shares, we call it treasury stock. We acquire treasury stock for some reasons or different reasons. Number one, to reissue the share to officers and employees under bonus and stock compensation plans. Again, to reissue the shares to officers and employees under bonus and stock compensation plans. Number two, to increase the trading of the company's stock. To increase the trading of the company's stock. If the management believes the stock is underpriced and want to increase its price, so this is one of the reasons to acquire treasury stock. Because when we acquire it, when we purchase it, we hope to enhance its market price. We hope to increase its market price. Also, another reason to acquire treasury stock is to have additional shares available for use in the acquisition of other companies. To have additional shares available for use in the acquisition of other companies. And also to reduce the number of shares outstanding. To reduce the number of shares outstanding. The outstanding shares, as I mentioned before, is the issued shares minus treasury stock shares. This we call it outstanding shares. Then another reason to reduce the number of shares outstanding and increase earnings per share. And the last one, to eliminate investors to provide a takeover. To eliminate hostile investors to avoid a takeover. And this is very important reason. So I mentioned 5 reasons to acquire the company's stock. And in this case we call it treasury stock. This stock we keep it in our treasury in the company, and we can dispose it by selling it or not selling it. This is what we are going to study also very soon. We can distinguish between common stock, which I mentioned the rights of the common stock, and preferred stock. Common stock and preferred stock both present ownership of the corporation. Both of common stock and preferred stock represent ownership of the corporation. common stock is the basic residual ownership. Preferred stock is ownership which has certain preferences. Preferred stock has priority or perform as to dividends, priority to dividends, and to assets in the event of liquidation. And even in the balance sheet, they mentioned before the common stock. So they have priority in case of liquidation. They have priority in distribution of dividends, and on the other hand, they have no right to vote. They have no right to vote. And they can have some characteristic, for example, to be cumulative or not. To be cumulative or not. Cumulative or non-cumulative. The terms and conditions of selling these or issuance these preferred stock can determine if it is cumulative or non-cumulative. Cumulative, it can receive the dividends for this year and in unpaid years. This is cumulative. This is transferable or not. Transferable, it means these preferred stock can be transferable into common stock with some conditions. And also, these preferred stock could be global or not. It can be global or not. This is also from the conditions we can issue when we issue these preferred stock. It will be indicated in the conditions. Either it is cumulative or not, transferable or not, and global or not. But this one, in all cases, have the right or have priority in distribution of dividends and in assets in case of liquidation. This preferred stock, actually, it has an agreed amount each year or a percentage. It has an agreed amount or a percentage of its value, its par value each year. Either an agreed amount or a percentage of its par value. This is the preferred stock, and as I said, it is come before common stock. So we have two types of stocks. We have common stock and preferred stock, and each one of these has its own characteristics and its own rights. And the main difference between both are the preferred stock has no right to vote, has no right to share in taking any decision concern the corporation. And this is very, very important. So I think this time is enough for these ones, and inshallah we are going to meet soon face to face إن شاء الله to complete what we indicated now. السلام عليكم ورحمة الله. Thank you very much.